the roadmap from the past that most people think that they have confidence in mapping to the future was not really going to work. And I talked about how with the Fed cutting interest rates, interestingly, long-term interest rates broke with the historical pattern that goes back almost 50 years. And that is when the Fed starts cutting interest rates, of course, short-term interest rates decline. In fact, they usually anticipate the Fed beginning to cut rates. In fact, I go one step further. The reason the Fed cuts rates is that the short end of the Treasury curve yields start falling because of market forces. But historically, every time, going back to 1980 anyway, when the Fed starts cutting short-term interest rates, long-term interest rates also fall. There was no exception to that going back to 1980. And what I talked about a year ago is I don't think that's going to happen this time. In fact, I went so far as to say, if we go into when the economy weakens or the markets weaken, we're going to have very different patterns than we had in the past. And that the dollar would not be a flight to quality asset. And instead, we would see other things become flight to quality assets. And what's great about the timing of all of that a year ago is we got put to the test almost immediately on this thesis because we had the tariffs show up on April 2nd, and there was market weakness accumulating before April 2nd of last year. But then when they announced the tariffs, people were stunned at how much higher they were than forecast. It was mostly a bluff, I think, and it turned out to be not implemented along that way. But the stock market went into it. It's hard to remember because it was reversed fairly quickly, but it was much more severe than most people would have anticipated. I think the S&P 500 almost went into a bear market. If you classically define as down 20%, I think it was down about 18%.
Exactly.
So, but what happened is that the U.S. market was no longer outperforming. That's unusual. Usually I think people think of that as a flight to quality asset. And the dollar went down. If you go back to S&P corrections, going back to the year 2000, there have been 13 of them since the year 2000. That means declines of 10% or more. Some of them are much more. The one in April of last year was quite a bit more than 10%. But there were 13 of them going back to 2020. The first 12 of them, every single time the US dollar index went up versus foreign currencies, and usually by about the same amount, about 8 to 10% during that S&P 500. This is the first time in the early second quarter of 2025, the first time going back 25 years or so, that the dollar went down as the S&P 500 fell. The dollar went down actually about 8 or 10%. Yep. And I believe this is going to continue to be a proven thesis because it worked out all the way through really 2025. I'm just really referencing that volatility period in my remarks I just made. But the US dollar assets for dollar-based investors, my recommendations going back about 18 months, and certainly I talked about this a year ago, is dollar-based investors should be investing in foreign markets in foreign currencies because the dollar appears to me to be in a long-term bear market. And it has a lot to do with, global tensions. It has a lot to do with overinvestment by foreigners in the United States having been made over a course of the past 16 or 18 years. And so a lot of things, one very major aspect that I think doesn't get nearly enough play and many investors aren't even aware of is that over the past 16 or 18 years, there has been a monumental move of foreign investors investing in the U.S. Starting about 18 years ago, the net foreign investment position was they were net long versus our investments overseas by dollar-based investors. They were net long $3 trillion of U.S. assets. Well, they started in earnest to add to those investments back then, and they added about $25 trillion over about 15 years. So you had something like $1.5 trillion come in net every single year. It's no surprise, it's well known that the U.S. market outperformed foreign markets almost continuously over that period. Do you think maybe there might be some causality? Sure, the U.S. economy was probably better and at times better managed. But when you have that type of net inflow, that's net buying. And so, of course, the US market had tremendous outperformance. But now there's so much, the imbalance is so great with $28 trillion of foreign net investment in the United States. And there's reason to believe that that trend is certainly slowing, but probably even reversing. So what will happen as we move forward? Well, that means that some of that net foreign investment is likely to go out and be repatriated into their own countries. And you don't need $1.5 trillion per year to have an impact. What if they just pulled out over a 3-year period, I don't know, $3 trillion over a 10-year period, $8 trillion or something? That is very likely to cause a reversal in the stock market in the U.S. outperformance. And that has certainly happened. Last year, a lot of smiling faces with the S&P 500 up nearly 20%, the NASDAQ up even more. These are nice gains, but if you're a dollar-based investor and you invested in emerging market index funds, even just index funds, you had a return of something like 37%. If you're a dollar-based investor and you invested in the UK, you had very substantially higher returns. If you're a bond investor and you invested in emerging market debt as opposed to developed market debt or certainly US debt, you did much better. And then the best of all is something that I didn't really recommend a year ago, but I started doing thanks to the increased confidence of how markets were behaving during that volatility period. For the first time I'm here now at DoubleLine, we started about 17 years ago. And over those first 16 and a half years, we didn't own any emerging market currency denominated securities. But last June, we decided it was time. And we started to move into local currency emerging market debt, not in all of our strategies because it's too high volatility for some more risk-controlled strategies. But for those that are more opportunistic, we added to local currency emerging markets, not on an index fund basis. We didn't want to own certain securities, particularly. We wouldn't want to own China. We wouldn't want to own certain of the countries in South America. But we do invest heavily in South America, in the more stable countries. And that has worked well. And I have a strong feeling that this is not the seventh inning of this outperformance. I think it's maybe bottom of the first. And so I strongly believe in that. This thesis, the primary thesis at the center of my investments, it's always it's exciting in the investment business sometimes. Sometimes it's kind of dull. There's not much going on. But then you start to think that maybe there's a sea change of fundamentals. And if I interpret them correctly, we could really see some differentiated, positively differentiated performance. And the center of that thesis is dollar weakness. I know I'm not alone on this. I was alone on that a year ago, but I'm not alone on that now because people tend to move in herds, and they don't want to be wrong alone. One of the things that plagues the investment consultant industry and the investment committee industry at large asset pools is they herd together. They don't want to be trailblazers because they don't want to be. They're more comfortable being right with being wrong rather with a lot of company than being wrong than being So they don't want to be wrong alone. And so I think that it's a little bit disconcerting that the dollar trade is now well established, that my yield curve steepening idea, which I was the voice of one crying in the wilderness on this about a year ago, is that the long end of the bond market is not going to rally unless it becomes manipulated. And there's a couple ways in which the long end of the treasury bond market can be manipulated. And when I say these things, a lot of people push back on me because it flies against their experience. But one thing they could do is if the long rates go up too much, and what does too much mean? I would say the long bond is about 4.85 today. I think if it heads towards 6%, they will start to get really worried about this little thing called interest expense, which isn't a little thing anymore. The national debt is very big. We all know that. But the interest rates were so low for so long that you didn't really see it. It was disguised by the fact that, the average treasury rate was at around 1.8%. And so with rates that low, I mean, just look at what Europe did. They put it at zero. If your interest rates are at zero, you can borrow infinity, and you don't have to pay any interest expense. You're going to have some trouble down the road when you have to pay the principal back, but maybe you just refinance that at zero again.
Yep.
So if the rate goes up too much, I believe there will be action taken. And I don't think this is all that radical of an idea because government officials have talked about this. Scott Bessent himself, before he was sworn in as Treasury Secretary, talked about this as well, that, maybe you do yield curve control, which they tried in Japan. A lot of people think that we would never do yield curve control. It means fixing interest rates, basically. The Fed can fix interest rates, obviously, at the short end. The market may revolt if they run too much of an inflationary policy, but they can also suppress long-term interest rates through a purchase program. The United States did that. If you think the U.S. won't do that, they did that. They did that after World War II. The debt was so high, and people were worried about inflation, and the government was worried about interest expense problems. And so, although economists broadly forecast that inflation was going to go up, and in fact, from 1945 until the mid-50s, it went up a lot. It went up from about 2% inflation, which is kind of where we started our journey pre-COVID, and it got up to like 8 or 9%. All that while, until 1951 anyway, they were fixing long-term interest rates at 2.5% and buying them. So one way to keep interest expense down is you do it artificially. It probably isn't a long-term solution, but long-term for a politician is the days to the next election, and so all they care about. So what they do, so you could do that yield curve control. They're talking about that. Another thing you could do is something that's much more radical, and I've gotten almost universal pushback on this, but I got an ace up my sleeve on this thing that I've come to learn subsequent to me cooking up this potential idea. I've actually learned some history of it, and that is you actually say, you know what, we used to have 1.8% interest rates. Now the average Treasury rate it's up at about 3%. Since no interest rate is at 3% or lower, we're about 100% higher than the aggregate coupon on the bond market. So, it means that even if you don't have a deficit, which we're running about a $2 trillion deficit, even if you didn't add anything, you'd have higher interest expense. For example, in the next 12 months, there are $10 trillion of Treasury bonds maturing, 10 trillion of them. If the rate goes up 1%, that's another $100 billion in annual interest rate expense. We've already had interest rate expense go from $300 billion about a decade ago to $1.2 trillion, $1.3 trillion, depends what exact fiscal year you look at. And so the interest expense problem's already gone up by $1 trillion. So what could you do? Well, what you could do, one thing is say, you know what? We wish we hadn't gotten ourselves in this situation, but we're going to do something. We're going to restructure the Treasury debt. We're going to take every Treasury bond that has a coupon greater than 1, and we are announcing today that coupon is now 1. And everyone that's below 1, we'll let you keep your below 1 coupon. So we're going to basically take the coupon down. Now, one thing that would do, since the interest expense is already up at around 3% or so, headed towards 4%, what would happen is if you could cut it from 4 to 1, or slightly less than 1 on average, you'd cut 75% of the interest rate expense. And that would buy you another, who knows how many years to build it back up and kick the can further down the road. And people say they would never do that. It would be a total disaster for everybody that owned a bond that had. If you owned a 20-year bond that was it probably was a 30-year bond issued 10 years ago, but it's still out there as a 20-year bond. If you have one of those with a 6 coupon and it turns into a 1, you're going to have something like an 80% loss overnight. And it's non-recoverable loss, because it's not like, well, when's it going to recover? They're not going to give you your coupon back. They're taking it away as it's an economic management. They couldn't, and that's why it's actually not a bad solution, because it forces you to go cold turkey, forces Nobody wants to go into withdrawal. We've got all of this. The economy is operating with all this interest expense. Everybody sees that the trajectory is really scary, but they don't want to go into withdrawal. So they don't want to go to rehab. But this 1% restructuring from every coupon down to 1%, it would make it so you couldn't borrow any money for probably 2 generations. So it's tough love, right? So you say this is never going to happen. Well, I've got news for you. It happened in 1881 in the United States under President Garfield. It happened. They basically were saddled with Civil War debt, and the Civil War debt was around 6% coupon. It's a crazy coincidence because I picked this 6% as a thought experiment back when I came up with this radical idea, and it turned out to be that's exactly what happened. It was at 6%. They didn't drop it to 3 under the Garfield to 1 under the Garfield administration. They dropped it to 3, and they gave people a choice. They didn't say we're turning your coupon from 6 to 3. They said you can either turn your coupon from 6 to 3, or we'll buy you out right now. We'll pay you cash. We'll redeem your principal. That's the same thing. If you've got a bond that has a 6% coupon for the next 6 years, and they give you 100 back, you have to reinvest at existing interest rate levels, not the legacy interest rate levels. So you're reinvesting at 3 anyway. So it doesn't matter. You're going from 6 to 3 one way or another. One, you're taking a principal hit, and the other, you're taking an interest hit, but they're actually identical. Neil Ferguson, who's a well-known and well-respected economic thought leader, he often talks about Ferguson's law. And you might think that it's Neil Ferguson's law, but it isn't. It's just a weird coincidence. It's actually Adam Ferguson's rule, and he lived from 1723 to 1816. So this goes back a long ways. And he came up with the idea that any great power that spends more on debt service than on defense risks ceasing to be a great power. So there's this trigger point when you're spending more on interest expense than you are on defense. And he goes back, he used at that time a couple of historical examples. One was the Spanish Empire in the 1500s, who had a crazy thing. They had 50% of revenue going to interest expense, and unbelievably, over 20 years, it went to 87% of revenue going to interest rate expense. Obviously, the empire collapsed under that because they didn't have any money for their military anymore. And there was, of course, a lot of corruption. Whenever you have that much debt and that much interest expense, unfortunately, it invites a lot of corruption, as we've seen all over the United States in more glaringly obvious terms in the past year or two. But basically, there was another example of an empire that did that. That was during Adam Ferguson's lifetime, and that was France. The Bourbon royalty, who went to 50%, got up to 50% of revenue going to interest expense. And that they got guillotined for that and other things. And then there was the Ottoman Empire, which in the late 1800s got to 50%, and they were gone by 1922. And then you had Britain in the aftermath of World War I with the same thing that sort of happened. So where's the U.S. now? Well, the U.S. now is at 20% of revenue, a little higher than that, but it rounds down to 20% of revenue going to interest expense. So our revenue is 5.4 trillion. Our budget is about 7.3 trillion. So if there's that big deficit in there of 1.9 trillion that's going to keep being ladled on, and the interest expense is already 1.2 trillion. And absent interest rate decreases, that would really be effective. Well, then, it's going to keep going higher. It will happen when you have contracting GDP. It will happen very rapidly when you have contracting GDP, because, of course, that's a double whammy. You have the decrease in tax receipts, and you have tremendous increase in expenditures for unemployment insurance and everything else. I believe that it's almost certain that we would have, by 2030, an economic contraction. Right. And I believe, therefore, that we're going to be in trouble by 2030. My own base case is actually 2029, something like that, but who knows with precision on that. When I started in this business, it's 45 years ago or more now, maybe even, people talked about the bad path that Social Security was on. We're doing a spend as you go, and the baby boomers one day would be not paying into the Social Security premiums. They'd be taking out of the system, and they're an outsized population. So they said in like 1980, this is unsustainable. This is going to be a problem. And the CBO, who makes some fairly optimistic, but not absurdly optimistic projections, they said Security Trust Fund will be broke by 2060. So people are like, okay, we got ourselves an 80-year problem here. Whatever, I'm not going to worry about an 80-year problem. I'll worry about my 4-pack a day habit 30 years from now, my smoking habit, so we won't worry about that. So then 10 years goes by and you get to 1990 and they have to do a new calculation because their assumptions had been, as they always are, a little optimistic. And so they say, you know what, it's not 2060 anymore, it's 2050. All right, so now we got a 60-year problem, still not going to keep people up at night. And then we go to, so let's just say 2020. We have a stock market problem. We had the global financial crisis comes in the middle of the '00s, and all of a sudden, they're going to run out of money by 2035, 2040, and now they're basically saying we're going to run out of money by 2032. That's the Social Security Administration. Now, they assume no recession. They assume deficit lower than it is. They assume interest rates lower than what they are now, and maybe they'll be right if we get the right certain policies that maybe the president wants. But it's no longer your grandchildren's problem. It's right here and now, and we're going to have to deal with it. Right. So this is what it's really about. And meanwhile, I'm struck so much by how ingrained even very experienced, well-regarded economists are in the old pattern. Fed cuts rates, all rates come down. I was watching a podcast with a guy who's pretty good. And it's a nice podcast because it's only about 20 minutes and he's a straight, you can understand what he's saying. And he was talking about, people are talking about how housing would be more affordable if interest rates would be pushed down by the Federal Reserve. But I don't know. I mean, they can't really control long-term interest rates. And he pointed out even in that podcast a couple of months ago, correctly, they've been cutting rates 175 basis points, but the long-term interest rates are up and the 30-year Treasury rate is up 100 basis points. But he couldn't help himself slipping into his, the old way of thinking, because about 10 minutes later in the podcast, he said, well, maybe we can get mortgage rates down if the Fed cuts rates the way Trump wants. I mean, even somebody that respectable and that capable of thinking fell back into that pattern. So I don't think manipulating interest rates is going to make housing more affordable, because markets function. If somehow by magic you could get the mortgage rate down from a little under 6% now to a little under, let's just pick a number, or a little under 4%, so down 200 basis points through some magic, maybe bond buying or something or other, all that would happen is home prices would go up. It's a supply and demand problem. It's not an interest rate problem. It's if you cut interest rates, you're going to have home prices go up. Look what happened during COVID. Housing prices soared. They had interest rates right flat on the map, way longer than they should have. They had a Fed funds rate at zero all the way into 2021. I mean, I remember Super Bowl Fed meeting 2021. I remember saying the Fed should raise rates 200 basis points today. And they raised them 25 basis points. And that's why I came up with this phrase just off the top of my head. Jay Powell needs to paint or get off the ladder. Either do your job or let somebody else get up on that ladder and do the job for you. And he finally got in sync on a very belated basis, but you'll notice that home prices didn't go down. They stayed sticky, and they've come down in some areas that were overheated, but not by any significant amount. What you need is supply, and you need supply that isn't so expensive. I've been traveling. I haven't seen the specifics of it. I mean, I think increasing supply is good, but when the government increases supply using government methodologies, a lot of the ideas will filter through money laundering schemes. Yeah. We see what's been happening. California has put $24 billion trying to get homelessness down over the past decade or so. $24 billion. It's been zero effective. Homelessness has done nothing but go up. So where did that money go? They've got a scheme to build mini houses, which are like, I don't know, 300 square feet or something. They wouldn't have any, they wouldn't have a kitchen. They wouldn't have any plumbing. They would just be a structure, and they would build them, and they put them, say, on federal land, say in Los Angeles near the federal building, and homeless people could live there and at least have shelter. You know what the estimated cost was to build one of these houses with no kitchen, no plumbing? It was about $1 million a pop. I mean, I start with the what they call the high speed rail that was supposed to go from Los Angeles to San Francisco. It was supposed to be done by 2020. It was supposed to cost $30 billion. And I've changed the name euphemistically to high greed fail, because they cannot complete this project. They don't even have the engineering skill to do it. It's just unbelievable that our generations ago, they were able to build Hoover Dam with technology far inferior to what we have now. And we can't build a high-speed rail anywhere near cost. And now they're saying that to get it from San Francisco to Los Angeles, it would be another, I can't remember, 15, 20 years, and it's $100 billion over budget. So there's no wherewithal for that. So what they've done is they've trimmed the project down. Now it's trying to get from Merced to Bakersfield, which is 1/4 of the distance between Los Angeles and San Francisco. And of course, it's 1/4 that nobody is interested in. And they're now saying that that's going to be $35 billion. So it's 1/4 of the project at more than, 1/4 of the project at a massive increase in the budget. So we're getting, everyone knew this was going on, but I think the order of magnitude is starting to get revealed. I mean, the Minnesota thing, now it's bleeding into Maine. You can't wait till the movie goes to California, because California is so much bigger, and it seems to be, I don't know if it's worse run or not, but it certainly has the wherewithal for that. There's plenty of evidence that that's going on. So, that's kind of where we are. And we have this interesting news lately that Warsh is talking about having some sort of an accord between the Fed and the Department of Treasury and the Federal Reserve, which is a very alarming departure from history, where the departure from history is they're supposed to be independent. Now, I know the question of independence has been out there certainly since LBJ didn't appear to have the Fed independent. Certainly, the Fed wasn't independent in the aftermath of World War II, and certainly President Trump has made a lot of noise about Fed should not be independent. So now we have the Fed chair-to-be and the Treasury Secretary talking about working together. That sounds a lot like manipulation to me. In fact, it's almost an admission of manipulation, and it sounds a lot like we're going to push short-term interest rates down and then fund a lot of debt short term, because we can control that rate. It's not going to be market driven. And when the long bonds get up there in yield, and I'm going to say towards 6%, we will manipulate them down by borrowing at some artificially low interest rate, like, I don't know, 3%, 2%, something like that. And we'll buy back Treasury bonds, and we'll be issuing short-term money at low rates, and we're buying out debt of ours that's at high rates. That's a kind of a version of that cut the coupon thing. It's kind of the same thing, but it's done more directly and in one way where it's a little bit more concealed. But he hasn't always been a hawk, and he has said publicly in the last few months that he can certainly see interest rates being brought down on Fed funds rate in the short term. So he's historically been known more as a balance sheet hawk, and this is something that I applaud. He thinks that it's wrong for the Fed to be out there with 6.7, one time was more than $7 trillion of treasuries. That's obviously manipulating things, and it seems like an inflationary policy. And if, in fact, Warsh is he's kind of hawkish tilt because he thinks deficits are inflationary. He thinks the Fed having a big balance sheet is imprudent and potentially inflationary, and he wants to shrink the balance sheet. But to shrink the balance sheet, you need to somehow fill the hole. If you shrink the balance sheet, you're shrinking the deficit, or you're making the market buy those bonds instead of the Fed. Well, if the private market buys the treasury bonds that the Fed owns, where's that money going to come from? It's going to come from banks. I'm not saying the banks are going to buy them, but I'm saying if Jeffrey Gundlach decides to buy some bonds because he thinks that the yields are good, I'll take money out of the bank, and I will now own bonds instead of having funded banks. Well, that's a problem for banks.
Yeah.
So this is a real issue. And it's one of the reasons why I think banks are not having the greatest performance on a trend basis. So he wants the balance sheet down, but to do that, I think to have an economic offset, since that would be restricted for the economy because you're shrinking the banking system, you might want lower interest rates. But every action has a consequence. You want the balance sheet down, that's a good thing, but now you've got short-term interest rates down, that's hurting the economy. It might be below the inflation rate, and so we have negative interest rates, and long rates are going up, and this is all kind of explains all of this together explains why gold has gone up so rapidly. One of the things that I've done with my own personal money the last two trades I've done for my own personal money are very anti-financial asset. I bought gold miners several months ago. Thankfully, it was incredibly lucky timing. And I bought more raw land. So these are things that have just absolute value. They're not manipulable. And in fact, the gold price is as Jim Grant so wittily puts it, as he often does, he says the gold price is the reciprocal of investors' faith in central planning and central bankers, because they think the currencies are likely to be debased. Certainly the dollar is being debased, and the dollar had been hanging in at about 98 to 100 on the Dixie index for quite a while. And that was exactly a trend line that goes back several years that has held. When the dollar has sold off, this rising trend line is held. We're through that now. And the dollar is now highly vulnerable. So I'm more enthusiastic than ever about, gold is up so much. I was out on my skis about a year ago. I was asked at a financial program, do you think gold's going to 3,000? And at that time, the price of gold was $29.70. He says, do you think it's going to 3,000? And I said, what kind of a forecast is that? You're asking me, do I think it'll go up 1%? I mean, who cares? I said, I think gold by year end is going above 4,000. I was out over my skis, but I was basically right, although it did here in 2026 actually go to 5,500, which does seem kind of up there relative to history, but I don't think it's going lower by any meaningful amount. And so I think that it's obvious that central bankers have been buying gold. One of the things that explains, I talked about foreign investment going into the S&P 500, and maybe that 28 trillion, some of it's going to go out, but I think that there's something going on with the central bankers who sold off gold at low prices for a long time. Starting about 20 years ago, they were selling gold and buying and putting reserves more in dollars. And so they sold gold at around $300 or $400 an ounce, and they increased their dollar reserves. Now they realize that their dollar reserves don't look that good anymore, and they've been buying gold back. And so central bankers have bought all of that gold back that they started selling 20 years ago, except they sold it at $400, call it, and they're buying it back at 3,000 plus. But central bankers used to have a lot of gold reserves. When we went off the gold system, the dollar became the king currency. People had the dollar thing, and they brought their gold reserves down to something like 15% or so. I think they're likely to double them. They were 70% at one time. If they just go to 30%, that's massive gold demand. And I think everyone is starting to realize that you are not secure in currencies that are being manipulated, and in this case, the dollar. which is likely to have an overly dovish Fed policy, in my opinion. I think we're going to be running an inflationary policy. And this is another reason why I'm not bullish on long-term treasuries until such time is that manipulation comes. So, but my job managing this type of money, at least in part managing this type of money, is I have this awareness that we're going to continue to lose money in long-term treasury bonds. The 30-year treasury bond lost 50% of its value during 2022. It went from 100 to 50. You know what? It's still there. Yeah. It hasn't rallied. It's still there at that low point. It's almost on the lows. So I think that we see that these trends are in place. The other thing that I thought was a real takeaway that's worth internalizing from 2025 is gold went up 70%, and Bitcoin went down. I mean, you would think that if people are dollar skeptics and are buying gold and are central bank skeptics, you'd think that maybe with the stock market enjoying a speculative rebound, you'd think that maybe Bitcoin could get somewhere, but it didn't. It fell about 6% last year, and it's not doing much of anything now either. So what is going on here? We had all of this speculation, and that that got up to a fever pitch level, and it seems to not be working anymore. So we have the U.S. market not outperforming anymore. We have Bitcoin not performing anymore. And the last thing, which is, I think, the thing of greatest concern, and I think that the worm has probably turned on this too, is the enthusiasm for private credit. Private credit became very popular in 2020 and 2021 when people had all that money that was being sprayed around by the government. And when they looked at traditional stocks and bonds, just look at the S&P 500 and the treasury bond market as placeholders, they didn't like what they saw. We had bond rates below 2%. Inflation was clearly going higher. As that opening video I was quoted from that time. I said it's obvious that inflation is going higher. And so we had that going on, and you looked at the S&P 500, and it was at nosebleed levels, kind of where it is now, or where was it? Yeah, we're kind of where it is now. You looked at bonds; they looked terrible. So you say, if I can map the public markets, if I can map a combination of stocks and bonds, if I can map that over to private credit, I'm probably not going to like what I see. But if I don't know what's in the private credit, I can't map it. So when things get really overvalued, people do weird behaviors. They start going into blind pools, SPACs and private credit and the like. And they basically say, I agree with you that publicly traded bonds look terrible. Publicly traded stocks look terrible versus their own valuation history. I'll tell you what, I'll put money in your lockup, blind pool, SPAC, or private credit fund under one condition. You don't tell me what you're doing. Because if you tell me what you're doing, I'll build a map over these public markets that are provably overvalued, and I'm not going to like what you have either. But what ended up happening is people like moving in crowds. So the big university endowments, they had been the pioneers in private credit, and they had done very well with it. And when the public market, when the bond market had the worst year of all time in 2022, people said, wow, look how great my private credit did. Because it didn't drop 50% like the long bond. Well, I've got a dirty little secret that the industry has. Private credit does not mark to market. Private credit is opaque and non-transparent, and it borrows the precepts from private equity, which is kind of its father. Private equity is private credit's father. What they do is they kind of use a moving average type of approach. So we actually have a DoubleLine paper out. It's up on DoubleLine.com this very day is when we debuted it. And it's called Volatility Laundering in Private Credit. Volatility laundering. So in other words, what you do is I'll just use the private equity example. You buy private, you sell your S&P 500 and you buy $100 of private credit. And the S&P 500 goes from 100 to 50. Private credit gets marked down from 100 to 80. It's probably not worth 80, but they are marking it down. So it looks like they're moving in the right direction, but then the market recovers. So the S&P 500 goes back to 100. Well, private equity gets marked back up. So you're back to 100 in both cases. But what's the difference? They both have a zero return, but one has more than double the volatility. At least it's stated volatility because it's a true daily mark to market. The other one is just a moving average of the actual prices. And so we've seen headlines like this. We've seen just total wipeouts in private credit start to happen late last summer when there was one home renovation company that was doing subprime loans that just famously went to zero in a matter of weeks. There were a couple of private credit funds that owned it, and they marked it at 100 at the close of one mark period, and they had to write it down to zero a few weeks later. 100 to zero. I mean, that's a steep slip. These are insurance companies that are owned by private equity. And then the private equity guys go and they fund private credit. So you've got something of a circular financing scheme going on, which is it's never a problem until it starts to be a problem. And it seems like that has begun to happen. I mean, you have I'm not going to name names, but you had a very highly respected operator, very highly respected, who announced that they were marking down one of their private credit funds 19% in a day. I'm not talking about one position. I'm talking about the fund is down 19. So are you telling me that half of your fund is really in good shape, so the rest is down 38%? Or are you telling me that 3/4 of your fund is in good shape, and so the rest is down 76%? See, this is what's wrong with these types of things. Got visited by a big insurance company client, and he came in, and it was probably in January of last year, and he had a very large private credit portfolio. And which is often the case, he used many managers. And so he said 8 of his private credit managers owned the same exact deal, which is not uncommon at all. Private credit's a very clubby group. They kind of used to be one big happy family, and they would all participate in the same deal. So it's not strange that 8 of them owned the same deal. What was strange is they had a mark to market period, probably at the end of the year, 2024, and he said the range of the marks on this exact same security, the high was 95, the low was 8. Now that's a spread there, 95 to 8. So again, this doesn't mean that the whole thing is rotten to the core, but the problem with booms, and private credit has boomed. It went from nothing in 2020 to a third of all leveraged finance today. And when you start out, you probably do have a pioneer opportunity. It's a new area. You probably have higher spreads. You can kind of control your terms. There's not a lot of you out there doing the lending, and it's kind of like the Wild West. There's a little town, and they're all God-fearing people, and there's a good sheriff. And everything's going well, and people are relatively peaceful. And then they discover there's gold 5 or 10 miles away. And all of a sudden, people start flooding into the town. Yeah. And in with some people that are legitimate, entrepreneurs are a bunch of scoundrels and a bunch of corner cutters and a bunch of people that are there to prey off of other people. And suddenly it's out of control. And I'm not saying everybody in that town is immoral or amoral, but there's enough of them that suddenly you've got a really big outlaw problem. And you got the High Noon movie going on. Sort of thing. That's what happens in boom periods of new financial markets. Just think what happened to subprime starting in 2004. Think about what happened in the repackaging market of loans and mortgages that got to a boom period in 2007. Well, private credit has gone up that same type of magnitude as subprime. And we're starting to see these types of headlines. And of course, the good operators are in a bind because they're kind of lumped together perhaps with some of the bad actors, and maybe they're honest when they say, I saw this in a Newswire story a week or two ago, there are no red flags in our credit portfolio. In fact, I don't even think there's any real yellow flags, so it's mostly just green flags. Yeah, okay, but what about all these headlines? What about portfolios being marked down 19%? That type of don't worry, be happy talk. I want to tell you, I spoke at a conference in Hollywood last summer, and I had turned out that by chance, my fireside chat was after a panel of private credit titans. I mean, these are the big guys. And I was really struck because I got there earlier, so I was listening to their dialogue, and I thought, wow, I've one thing that experience is good at is you can spot the way people contort their language. So when things are going well, they're all smiles, and you can tell they genuinely are optimistic and bullish. And then when things start to get a little shaky, they start to say things like, "Well, we're kind of we kind of need more runway on our deals, or we can't cash anything out because we told our investors there was a 3-year hold period, but we haven't had any returns in 3 years." And so we're asking them for more runway, and we need more money. We can pay your dividend by issuing you more shares, which is called pay in kind in the high yield bond market.
Yep.
And one of the red flags of high yield bond market is when you pay in kind starts to go way up. Well, that's what's going on in this area. So I heard this panel, and they were sounded about what a CLO panel would have sounded like in 2006, 2007. When you talk to high yield bond people, that the most bearish thing they're ever going to say at the beginning of a year is they'll say, well, spreads are tight. That's true. And, we are starting to see a little bit more stress in the system. So we don't really think you're going to get a price gain this year, but we think you're going to earn the coupon. That's a bearish call from a high coupon sort of asset pool. And that's exactly what these guys were saying at this panel. So I just said, this is getting kind of weird. And then I gave a speech, and there was a private credit person on in front of me, and she was mostly a marketing person, very good speak, very slick, very polished. It seemed like she had memorized a marketing pitch. But they all say this. They say the thing about private equity is it's lower volatility. Yeah, maybe it's a little higher return, but it's also lower volatility. Well, it's a Sharpe ratio argument. It's that fake volatility again. So that's not really a legitimate case. So then they go to the next talking point, which is at least was a few years ago truthful, and that is just look at the past performance. Look how well private credit has done versus public credit for the past few years. And that was a truthful statement a few years ago. But that started to become untrue in October of 2022. Private credit has underperformed, even though it's not even properly marked, even on the way it's marked, which is probably optimistic. It's underperformed public credit for that time period. So that argument, and by the way, as they say in the prospectuses, past results are not indicative of future performance, right? Usually in my business, where I'm doing public things and people are allowed liquidity, if you underperform for 4 years, you thank your lucky stars you got a client left. When you underperform for 1 year, you can explain it away. You underperform for 2 years, hopefully they're longer term oriented. You do 3 years, and you're going to start getting the big redemption notice. 4 years, it's done. But yet, private credit has done that for 4 years, and yet you don't hear anyone talking about that. And then the third argument is a cynical repackaging of the initial Sharpe ratio argument. They say, and another good reason to have a lot of private credit in your portfolio is that when markets get volatile, it helps you sleep at night to ride out that volatility of your private credit, which of course, again, is just the moving average pricing. So at this juncture, I think there's really no reason, because the spread on private credit, which used to be kind of juicy back in 2000 and 2001, the juice is out of the orange. And so it's not totally out of the orange, because private credit obviously demands a higher interest rate than public credit. But wait a minute, if you have to pay private credit a higher interest rate than public credit, why aren't you going to public credit? Why? Because they won't take you. You're too risky. So the question boils down to, is 200 basis points of excess return on just the stated side, and you hope that the losses won't be worse, but they will be, because the ratings of private credit are substantially worse than the ratings of public credit. The B minus sector dominates, B minus and lower sector dominates public credit, and private credit to a much greater extent. It's only about 28% or so of public credit. Well, I think the first part of your question, both sides are right. I do think it's going higher, and I also think it's a storehouse of value. I actually think those things are really two sides of the same coin. For the time being, I think you're okay in gold mining stocks. Now, junior gold miners are very risky, but they haven't really performed all that much. And with the price of gold going up, the junior miners are likely to be bought by the senior miners. There's going to be likely consolidation.
Mm-hmm.
So you have two ways of working in the miners. You get a takeout, or else just the sector as a whole goes higher. Physical gold is very difficult. It's very difficult to do, but if you can, that would be the preferred method of actually owning it. I would not. The gold ETF is not for long-term storage of value. Gold ETF is simply a trade. It's a way of getting quick exposure to the sector. And there's nothing wrong with doing that, but don't think that if suddenly the dollar gets revalued down massively, right, that somehow you're going to be immune from that. That's why I kind of buy land. So, for example, the land that I've bought is a timber ranch.
Mm-hmm.
So it's basically farmland. It's very efficient to own because you get very substantial tax credits. And so I'm running a timber farm, and I don't know how to run a timber farm. I mean, how do you do the controlled burns and what level to thin it to? So I hire a company to do that. And the lumber is very useful. So they do the burns, they thin it out, they harvest it in the optimal way, and they pay me because they take a significant fraction of the wood, because I got much more than I need for just my fireplace and my boiler, to heat the house if something goes wrong with the grid. So, but it's tremendously efficient. It's almost, I think I have negative. I think it cost me negative to carry it. I like farmland, or else a quality of life aspect. And in an area where it's reasonable to believe that there will be population increase, and that in spite of population increase, the quality of life is very, very high. So a timber ranch really fits that, because it tends to be in a rural area. Rural areas are gaining in population more than urban areas primarily. And the quality of life is worse probably than it was 30 years ago, but it's way better than it is right now in major cities, and it will probably continue to get worse over time, but at a far more gradual pace. First of all, it's at absolute nosebleed valuations versus its own history. This doesn't happen very often. It's broadened out a little, but it's at a very high valuation versus like the CAPE. Dr. Schiller's CAPE ratio is extremely high, and all those measures. But also, I think foreign markets have especially emerging markets, have a tailwind. And if you take a look at the Morgan Stanley, the MSCI index, and you just look at the United States piece of it, and you look at everything in the world other than the United States, the United States price to book is it's about 2.5 times that of all of the rest of the world. It's a kind of a multiple that, I mean, you can come up with reasons why it kind of made sense during the big build out boom of data centers and AI and all that stuff, but that's not sustainable. And so I think on a valuation basis, it's really obvious. And also, again, at the center of all of this is an anti-dollar view. As a dollar-based investor, you're going to get the currency translation. Where are you going to get the currency translation? Well, it's probably going to be in solid emerging market areas, and it's already begun to happen. That's what's so great about this is my anti-S&P. Like, I want none of it. You could have made that argument convincingly 2-3 years ago, and you haven't been terribly wrong, but you've been wrong. The S&P continue to outperform, but it's already reversed. We see EM is outperforming. UK is outperforming. A lot of these are outperforming. Like growth has stopped outperforming value. Not terribly convincingly, but it has. small cap versus large cap. It's kind of convincing. And so it seems like you have a couple of fundamental pillars that are there, and also it's not so much that I'm waiting for it to start working. It has started to work, and it's not late in the trend. And our emerging market team has really been doing very, very well in recent years, and they're very Latin America focused, which I think is a good place to start. Although we've been pretty much steered clear of Venezuela and Argentina for years now. Now, you had a beautiful day if you were a Venezuelan investor when Maduro got booted out of there. The bonds went up like 20 points, but they fell a lot more than that before then too. So net to net. Now, when it comes to, I like Southeast Asia for equities. I would never invest in China as a U.S. investor, so forget that. But other Southeast Asia, and then for the long term, for the kids' college fund, I've been recommending this for years, is Indian equities, but it's a demographic powerhouse of a story with a history, with a highly educated ethic, and the ability for improvements through elimination of corruption, the legal system, and everything else. I believe in it, not for this year, not for the next 3 years, but for the next 30 years. I think you're going to have a repeat of China in India, over just like China did for the last 35 years. I think that's where you're headed. Just don't look at your statement, because when it goes down 20, you're going to sell. But if you hang in there, you've probably got a 10 bagger. It's really all the same thing as the stocks. It's really we want real economies. We want Latin America again. We actually own some India bonds for the first time, I think, starting about 2 years ago. They haven't performed all that well. India's been kind of a sleepy spot lately, but that means it's a good time to buy it.
Yeah.
I mean, we have our DoubleLine Roundtable Prime at the first part of January every year, and we have the same group of people. And Charles Payne, who I really like, has been on the panel every year, or nearly every year, and he was talking about a company that makes small nuclear reactors. So they can power like a data center. They can put out a lot of power, but they're not so huge. And he recommended it last year, and he said it went up massively last year, and it gave it all back. He said it gave it all back. So I turned to him and said, "So aren't you buying it now?" And he said, yeah. And so that's that kind of a thing. Sometimes when the fundamentals are really good, a big gain can be given up just because of speculative change in the speculative trend. Like, for example, one thing that's risky about gold, and we saw that one day where it dropped $500 intraday. One problem with gold is that if there's trouble in the world, typically in our environment today, you would expect gold to do well, and it has done well. But if you go into a sell-off in risk assets, if the stock market drops 15%, or broadly speaking, there's other problems, there's credit defaults or something. What people do when they have an asset class that they own that is in free fall is they sell something that's not in free fall. They sell things that haven't started going down yet. And so what happens is the things start going down simply on flows. Gold has vulnerability on that. But I wouldn't worry about it. I would not sell gold at 5,000. I don't know where it's going as a target at this point, but my target is higher. Yeah, I like commodities. We had been positive only on gold for the first part of last year, but once we got some of the industrial metals going, copper and such, we have the BCOM index, which is the one that I look at, BCOM on Bloomberg Commodity Index. It finally started living above its moving average, 200-day moving average, after about 2.5 years of living below it. It got above it, which was a sign that maybe something was stirring. And then the 200-day moving average started moving higher. And so now we have a bull market in commodities. We're positive on commodity index broadly, and we're positive on gold as, add a gold only exposure. So you're kind of overweight gold in the commodity complex. But we're bullish on the BCOM index. Yeah, that opportunity was pretty attractive about 3 months ago or 4 months ago. It's performed quite well since then, which is fine for the last 4 months, but it means that the opportunity is less than it
Right.
was. I still think it's the cheapest sector in the investment grade bond market. So it still has that going for it. But the easy money has been made. But one thing that's positive about the commercial mortgage market is there has been a very palpable improvement in the mood. The
Yeah.
people aren't instantly hanging up the phone on you when you say commercial mortgage securities might be something good. They're now actually saying, I mean, there's actually uh, kind of a feeding frenzy that started a few months ago, where deals were being brought to market and being oversubscribed like 15 or 20 times. So that means that there's a lot of positive sentiment. That's not in and of itself a one variable green light. When you go from really sour sentiment like we were in for 3 years, and it starts to become okay, that means that it's probably on a performance run in positive direction. I think today I would have a little bit more cash than I would typically have, um, waiting to deploy into more risky assets. And I would put that percentage at 20 or 25%. I would have, for a typical investor, I would have about that same breakdown, maybe 20% in real assets, gold, land, commodities. I personally have more than that, but my circumstance is not is more unique than typical. And and then equities, I would have about 35% in equities. I think they're overvalued, but I would have them 100% in non-dollar local, not non-US local currency markets, 100%. So it's risky, but you've got against that, you've got cash and you've got these real assets. And then the remainder is in a intermediate to short, reasonably high grade bond portfolio, which is not very sexy, but at least it's very low risk. So we're talking about maturities of 7 years and mostly in the investment grade or double B is the lowest type of credit in there, because I think you're going to get better opportunities almost everywhere. So, but you want to be invested significantly with different profiles over time, but over the course of time. So that's where I am. It hasn't really changed much in the past year, which is one of the things in the investment business that is the most difficult is to make changes after you've been right. That's really hard to do. So my thought process these days is I've been right. I've actually been quite right in the past couple of years, last year in particular, and it's done very well with that. But don't get complacent about that. Just because you're right doesn't mean that this is going to be a one-way thing. Because when you're right, particularly when you're managing other people's money, it's difficult because if you bought Apple stock at $5 and it went to $500, you have this great thing. In every client meeting, you can say, "Look at this, cost five, last 500. Look at this, 100x." And so that gets a good tone going in a meeting. You've made the money, you feel good about it, you have emotional satisfaction. But if you sell that Apple stock, suddenly that's not there in the portfolio anymore, and you don't have this wonderful thing to talk about. And since it went from 5 to 500, in addition to these things I just said, you have just a tremendous attachment to it. It's when you. I remember when I first bought bank stocks. I was out of bank stocks for years and years and years, and then finally I decided it was time after the global financial crisis to buy bank stocks, and it just felt so strange. I felt like I was in a strange place in a strange land, because suddenly I was like a bank stock guy, and I've been anti-bank. So it kind of affects your own psyche. I know most investors aren't down in the weeds enough to perhaps know what I'm talking about, but it really is hard to make changes after you've been right. It's like you lose an old friend. But having said that, I'm not making changes.
Okay.
I'm staying where I've been because I think we're early on. I think that large deficits are ultimately inflationary. And so I think we will be having not a terrible inflation problem in 2026. In fact, it might be pretty benign. The tariffs don't seem to be all of that impactful, maybe 3/10, 4/10 to the CPI. It really doesn't look like we're getting much more of that. So GDP right now that's being reported is incredibly skewed towards a couple of sectors, but so is inflation. So we have a very diverse set of economic statistics, but I think ultimately deficits will lead to inflation, and so we'll have inflationary policy.
Mm-hmm.
So I think that the inflation will be viewed to be maybe not in a conscious way, but in the air, it'll be viewed to be a better solution than an outright debt collapse. It's going to be incredibly destructive for the old institutions. It'll be very destructive for large parts of the society, but it's what has to happen. I think we will chew that any default pressure on debt, which would be really a problem. It would cause tremendous deflation and a collapse of the financial system. It will encourage a pivot to inflationary policy. And what will come with it, you see, if inflation is the answer to wealth inequality. If people are worried about wealth inequality, if you have hyper inflation, then everybody's affected by it. It's one of the reasons why inflation ends up being chosen at crisis periods, because it's better than the alternatives. And what actually will happen is we will have a society where individualism becomes less coveted, and community and involvement in societal will become much more desirable. I feel like that trend is already in its nascent stages or beyond, because people are incredibly mentally ill with their isolation from other people. Shutting down the schools during COVID was just a fatal blow to an entire generation that will be scarred with mental illness from it for a long time, and maybe their whole lives. And they will start to see that community and interaction and knowing who your neighbors are and caring for them will be viewed as much more rewarding than how many likes you got by people that you don't know and probably aren't even real people. So that's what I think is coming. And there's a book that Neil Howe, the guy that wrote The Fourth Turning, recommended to me, and he said it's called Bowling Alone, and it speaks to this trend and how it will reverse when we get to a new structure that's coming in the next several years at most. And what we've talked about is during the 50s and 60s, people loved having community involvement. They had potluck dinners at their church. They went bowling with their bowling league. They would be members of the Elks Club. Now nobody goes bowling except if they go bowling alone. So it's all about how there's this pendulum that swings back and forth, and you can go through hundreds of years of data, and it's usually about one generation being encouraged for whatever reason to be ruggedly individualistic to the point where it becomes excessive, and then it swings back to more of a sense of community.
Yeah.
That's where we're headed, and that's going to be really good. We got to get through the valley. I think AI has really run through its first phase of investor and business people enthusiasm. I think they're starting to realize that the progress pace that they were very excited about is not really possible in a straight line. I mean, I am not a huge AI user. I have a lot of people on my team that do. But when I do Google something, and AI thing pulls up automatically, and I find it to be inaccurate. But I also think that AI can never create anything, ever. And so I think this idea that it'll take over some creative things has a very, very strong dead end to it, because I, I can't imagine what it's going to be in college classes where you have to submit a paper. And we're probably already starting to get observations where the professor gets 10 papers that are identical. And that just isn't going to fly. That just isn't a productive thing. It has to be discarded. So with fits and starts, we'll find a way to implement it. I think one of the reasons, going back to the S&P, but it maybe has more to do with the S&P, more the narrow group. But I kind of want nothing to do with it, because I think we've gotten into that. We've extrapolated the joy of and the overbelief, and now we got to dial that back. We don't have the electricity for it. It's just like the windmill craze. I feel like that was so overbelieved. Now people have started to realize that windmills create negative energy. I mean, it's like, what are we doing here? I'm optimistic that the frustrations that I was experiencing, say 6 years ago, that I felt like I was the only person that saw that we needed to fix things, that people felt that everything's just A-okay and we can just keep doing this forever. And I'm encouraged that a lot of people that had never even thought about some of these problems now recognize them, because that's exciting, because that means you can get to it and make something positive happen, instead of keep circling this drain of non-sustainable financing and societal relations, particularly in wealth relations.